If you think debt is background noise, you are already late. Because the longer you ignore it, the fewer neutral positions remain, until indifference itself becomes a narrowing stance rather than a shield, and passive ownership becomes participation. The United States now owes over $38 trillion, the highest figure in its history. The European Union carries around $14 trillion, Japan almost $9 trillion. And even oil-rich nations like Saudi Arabia or export powerhouses like Germany and China carry enormous obligations of their own. And once that scale becomes universal, the comforting idea that the problem belongs somewhere else quietly disappears, leaving no surplus geography where pressure can be relocated, and no external balance sheet large enough to absorb it without cost. That is where the paradox closes in. If everybody owes money, someone must be owed. Yet the moment you follow that logic forward, you discover there is no obvious outside party waiting at the end of the chain. And the absence of a clear creditor removes the illusion that distance equals safety, eliminating the possibility that accountability sits beyond the system, and making internal adjustment the only remaining mechanism of correction. Debt is not a side effect of the modern world. It is its architecture. Every war, every crisis, every boom and bust has rested on this invisible scaffolding of IOUs. And once you begin tracing the chain of creditors far enough, the trail loops back on itself. And one option falls away. The world does not owe money to anyone in particular. It owes it to itself, which means there is no final counterparty left to absorb the imbalance. That realization does not level the field, it narrows it. Because when a system owes itself, there is no external balance sheet to reset against, and once that external escape is gone, the only adjustments left must happen inside the same closed loop. Redistributing strain rather than discharging it, which makes correction dependent on internal trade-offs rather than external relief. To understand how we reach this point, a planet carrying more than $315 trillion in total debt, nearly 3 times the size of the global economy, we have to step backward to when debt still had visible edges and outcomes still ended, before continuation became the default and closure became optional. Centuries before the first credit card swipe or digital transfer, national debt was born not in commerce but in war, and in 1694 England was fighting France and running out of gold. A moment when survival required a decision that could not be undone. The king turned to merchants and traded future taxes for immediate endurance, locking the crown into a permanent stream of interest payments that would outlive the war itself. And in doing so, he removed the option of returning to pre-war financing without first confronting the obligations he had just cemented. From that point forward, any attempt to fund the state without borrowing would have required contraction severe enough to unsettle the very order the borrowing was meant to preserve. To manage that commitment, the Bank of England was created, and with it, the state gained the ability to spend money it did not yet have while surrendering the ability to return to a world without debt. Because once survival depended on borrowed time, the old option of funding through existing means stopped being viable, and any attempt to reverse course would have required immediate contraction. The institution did not merely facilitate borrowing, it normalized it, embedding market expectation into the machinery of governance and narrowing future policy to what creditors would tolerate. In exchange, lenders received something more powerful than gold, a government promise that could be traded, bought, or sold. And with the birth of the government bond, repayment ceased to be the central objective while circulation became the new engine. A shift that permanently altered the structure of power and made liquidity more valuable than liquidation, leaving future governments tied to markets that now expected continuity rather than settlement. Once those promises were tradable, withdrawing from them would have meant destabilizing the very system built to sustain them, making permanence less a choice than a condition. France copied it, and the Netherlands refined it. The newly independent United States adopted it to fund revolution and expansion, and with each adoption, the alternative of refusing to borrow shrank. Because national debt ceased to signal weakness and began to signal credibility, turning the ability to borrow into the ability to rule, and making abstention from debt look like retreat. Empires once conquered territory to extract gold. Now they issued bonds to extract interest. And when the battlefield moved from land to the balance sheet, leverage migrated from armies to credit. Binding power to the willingness to sustain debt rather than eliminate it, and ensuring that influence depended on continued participation in the same financial structure. 3 centuries later, that structure has expanded beyond any single empire. The United States owes $38 trillion, Japan over $9 trillion. Global borrowing increases by roughly $1 trillion every 100 days. And when that rhythm becomes expectation, the option to pause without consequence quietly disappears. Because interruption would mean confronting obligations that were priced for continuation. Every country owes, and every bank lends. Every citizen, through taxes, savings, and pensions, stands on both sides of the ledger at once. And once the rope tightens, there is no clean way to drop it without pulling someone else down, making exit a collective rather than individual decision. Start with the United States because its debt is not merely national. Of the $38 trillion owed, about half is publicly held, meaning owed to investors rather than internal government accounts. And roughly 2/3 of those investors are American institutions, banks, pension funds, mutual funds, insurance companies, and the Federal Reserve itself, locking much of the obligation inward and tying domestic stability to the continued servicing of that debt. The remaining third, roughly $9 trillion, sits in foreign hands, with Japan holding around $1 trillion, China about $800 billion, followed by the United Kingdom, Luxembourg, and Belgium. And while it is true that America owes China, that portion amounts to only a small fraction of the total, removing the convenient narrative of a single external master and reducing the option of external blame as a political release valve. The Treasury issues bonds and banks and funds buy them. The Federal Reserve often buys them back, creating new dollars in the process. And Americans pay taxes that fund the interest on those bonds, which then flow into American retirement accounts, completing a loop that feeds on its own continuity and leaves little room for abrupt exit. Because breaking the loop would immediately destabilize the very accounts that depend on it. This circularity extends beyond any one country. Japan lends to the United States through treasuries, and the United States lends to Europe through the IMF. Europe lends to developing nations through the World Bank. Developing nations lend back to advanced economies by parking reserves in Western bonds. And with each pass, the system grows more interlocked and less escapable, reducing the number of independent actors capable of stepping away without triggering chain reactions. Every country holds someone else's IOU, and every promise is secured by another promise. It resembles a poker table, where every player has borrowed chips from the next, and the only condition keeping the game alive is that no one stands up. Because once someone does, the borrowed chips must be reconciled, and the illusion of abundance collapses into visible obligation, forcing settlement instead of rollover. Behind this visible exchange sits a fourth layer: markets. Hedge funds, pension funds, sovereign wealth funds, and central banks managing tens of trillions in assets decide which nations can borrow cheaply and which must pay a premium for survival. And when confidence shifts, they do not negotiate, they reprice, immediately narrowing the borrowing window for those already stretched. When they lose confidence, currencies collapse, governments fall, and economies are restructured with little regard for domestic politics, demonstrating that democracy may decide who governs while markets decide who survives. And survival under pressure removes options faster than debate can restore them, compressing political timelines into financial ones. At the center stands the modern central bank, which does not merely manage debt but manufactures it, buying government bonds and creating new money in exchange, transforming one institution's liability into another's asset, and deepening the dependence on continuation, because each intervention makes future withdrawal more costly. Every dollar in circulation represents debt somewhere else. There is no debt-free money in this system. And as long as investors believe governments will pay interest, even if the principal is never retired, the machine keeps turning. Substituting belief for closure and making stability contingent on sustained confidence rather than balance. But when confidence wavers, the consequences arrive quickly. In Greece, in 2010, debt became unpayable, bondholders panicked, yields spiked, and intervention from the European Central Bank and IMF arrived not as relief but as constraint. Because bailout meant austerity, tax hikes, spending cuts, and mass unemployment that reshaped an entire generation, removing the option of domestic policy autonomy in exchange for liquidity. In Argentina, repeated defaults turned debt into stigma. And in Sri Lanka, fuel shortages and political collapse followed when foreign currency ran out. And in each case, the creditors who once seemed abstract became visible, their terms replacing domestic discretion almost overnight and reducing national flexibility to compliance. Yet even after collapse, the logic did not reverse. New loans replaced old ones, and old debts were restructured. The machine restarted under different labels, because in the 21st century, debt is not designed to be repaid, but to be rolled forward. And once refinancing becomes routine, stopping becomes synonymous with breaking, eliminating the feasibility of abrupt settlement without systemic shock, and ensuring that each rollover increases dependence on the next. Governments today do not plan to pay off their debt. Not now and not ever. Individuals repay principal. States refinance, issuing new bonds to service old ones, turning interest into the system's central product and narrowing the space for alternatives. Because any attempt to extinguish the principal would drain the collateral the system relies on. The global economy now depends on that rent. The United States will never clear its $38 trillion. Japan has rolled its debt for decades, now exceeding 250% of GDP, and yet yields remain low because investors are not waiting for repayment but renewal, choosing continuity over confrontation and accepting extension in place of resolution. Government debt has become the safest collateral in existence. Pension funds hold it, and banks secure themselves with it. Central banks treat it as money. And if Washington somehow paid down every dollar it owed, the world would lose its most trusted financial instrument, shrinking the money supply and triggering deflation and collapse, making repayment itself destabilizing. So governments do the opposite. They issue more, not recklessly, but rhythmically, because the debt has become the heartbeat of capitalism itself. And political promises to eliminate it sell comfort rather than reality, since elimination would dismantle the foundation the system stands on and force immediate contraction. The goal is not to end debt, but to keep it serviceable and desirable enough that belief never breaks. Because once belief fades, numbers stop mattering, and interest rates spike, freezing an economy built entirely on rolling promises, and removing the option of painless adjustment. That is the structure of sovereign debt. The plan was never to pay it back. The plan is to keep the world believing it will, sustaining a closed loop of trust that stretches further as long as confidence holds, and compresses rapidly when it does not. But trust is not evenly distributed. Interest flows upward from taxpayers and workers to the institutions and investors that hold the bonds. And debt becomes not merely a transfer between countries, but between classes, linking rising inequality to rising indebtedness, and concentrating claims within fewer hands. The system rewards those who own debt and burdens those who service it, scaling the same dynamic from households to nations to the planet, until the distinction between debtor and creditor blurs into shared participation in the same engine and shared exposure to its limits. The danger emerges when the engine runs out of fuel, when new borrowing cannot keep pace with old promises. Because at that moment, the question of who the creditor is stops being theoretical and becomes personal. And the margin for delay narrows to the pace of rollover. At the top of the structure, there is no single face to blame. Not China or Wall Street, not the IMF. It is all of them, and us, bound together in a system that has turned debt itself into money. With governments issuing it, banks multiplying it, investors trading it, and citizens depending on it, leaving no participant entirely outside the chain. Debt once meant bondage. Today, it means balance. But if that balance ever tips and confidence fractures, the illusion ends. And what remains is the reminder that every promise made on borrowed time eventually confronts its limit.